In this video, I'm going to take you from a complete beginner to investing money in your first stocks. All you need is a phone or a laptop, a Wi-Fi connection, and $100 dues. For those of you that don't know me, my name is Darragh, and on this channel we explore ways of young people can live happier, richer, and more productive lives. So you want to get started with this investment thing or this investing thing, but you don't know what to put it in. You know you don't have enough money to buy a house, which would be the obvious thing you'd do if you had a lot of money. You've heard Mary down the road talking about cryptocurrency and how risky it is, and your brain is a little bit frazzled as to what you want to put your money into. If you lived through the recession back in 2008, you saw many people lose lots and lots of money with property and with bonds and stocks and shares, and you might be a little bit fearful to put your money in these kind of assets because you don't want to lose your money too. And if you didn't live through the recession, I applaud you for watching this video at such a young age. Well done. But the idea behind it is that, well, maybe it's safer to stick your money into a mattress instead. But the data shows that doing that is probably one of the riskiest things that you can do, and an even riskier thing for you to do is do absolutely nothing with your money. Why is that? Well, we'll get to that in a second. So let's say at this stage you're already a little bit convinced anyway that you want to invest your money in something, right? But you really don't know what to do because investments and investing in things is very much a black box that you can't do without a financial advisor. By the way, this isn't financial advice. You can't just go into Tesla and buy a Tesla stock in the Tesla store. That's just not how it works. You might see all this lingo going on like S&P and FTSE and all these different types of documents, and there's a little bit of fear that if you do something wrong you'll end up going to jail for tax fraud. Now don't worry, it's not that serious. All it takes is just doing the first step. I don't know how long this video is going to be. This is going to be a bit of a long one because there's a lot of key points that we need to go through, but it is one that you're going to want to stick to until the end. We're going to talk through some of the stuff that the likes of Ray Dalio and Warren Buffett talk about in their investment strategies that has worked for them. They're some of the best investors in the world, so they're definitely worth listening to. We're going to break this up into 12 different steps. I'm going to put them all up here. Feel free to play around with the timestamps depending on what areas you'd like to go at, but it's best to watch this in order. So let's start with the first topic. The first topic is, why should you invest? Well, you should invest because of this thing called inflation. Now, you might have heard of inflation before, but not really understand what it is. Your money loses value over time because of inflation. You lose around 2 to 2.5% every single year. Now, think of it, for example, back when you were younger, you could probably buy a chocolate bar for half of the price you are doing today. That's because the value of money is decreasing over time. I think the average is 2 or 3% a year, so let's just call that 2.5% a year. Now, you might think that's a small amount and it's not really something that you should consider, but when you look at this over a long period of time, trust me, it definitely is. So the only way to stop you losing your money over time is to get your money earning interest at the same rate as inflation. So that way the value of your money isn't decreasing over many years. Because if you think about money, money is just a societal construct, right? That society agrees that it is worth X amount. They agree that the pound is worth this in comparison to the dollar, to the euro, and it's just a way that the governments can measure how much these currencies are worth. And there are many ways for us to take advantage of that ourselves. Because if you think about it, money isn't fixed. Money is a societal construct that is worth what society agrees what it is worth. If there was an alien invasion tomorrow, money would be worth absolutely nothing because we'd be too busy fighting the aliens, and if the aliens won, then you're not going to hand them a $20 note asking them to set you free. It won't mean anything to them. You'd just be using it as, kindle for your fire. Unless it was Australian money, that stuff doesn't burn. Anyway, back to the point. So the example of having the money in the mattress, right? For every year you leave in the mattress, it's losing 2.5%. Now, it doesn't sound like a lot, but thanks to the eighth wonder of the world, now that was Einstein coining that term, compound interest will make sure that your money will appreciate a fair bit over time. Let's say, for example, you won $10,000 in the lottery. First of all, that would be an awful lottery win. Sorry about that, but it's a good figure to use for an example. If you were to stick that in your mattress, right? 2.5% is being lost every year. So if you leave it in there for 10 years, that will decrease all the way, let me get the figure here, to $7,773. So you're losing nearly 25% of your initial sum over those 10 years when you compare it to the present day value. Okay, so maybe you might not want to put it into your mattress, but you might want to put it into a savings account in a bank. Now, the thing with that is that banks give you very little interest in whatever you put in your savings account. A figure I got here on the web, on the internet or on Google, was 0.06%. Now you're definitely losing out on money there because inflation, which is 2.5%, is outrunning your interest a fair bit there. So let's get on to the happier bit. Step 2, how do you stop losing your money? So what you need to do is you need to make sure that your money is making more than the hypothetical inflation of 2.5%. So if you have a savings account that increases at the same rate as inflation, you're not losing any money. That's the benefit behind it. But you don't want to go just to that point. You want to go further, and you want your money to gain more interest every year than what inflation is decreasing your amount by. So imagine you were able to get a savings account of, 10% annual interest rate. Now, first of all, that would be absolutely outrageous. So let me know if you do get a savings account that increases by that much every year. But the idea behind it is that you want your interest rate to beat the 2.5% inflation rate. Now, you're probably having nightmares already going back to your maths exam when we talk about compound interest. But in this case, you should maintain some bit of curiosity, because in this case, compound interest can make you lots and lots of money and not get you 5 extra marks on the exam. So most savings accounts will offer you a really small interest rate. That's why you want to invest it instead. So this goes on to the next point. What is an investment? Now, you have lots of different types of investments. You have housing, which is one of them, and it's pretty unattainable for a lot of us at the moment because the prices are so high. You have bonds and treasuries, which are like government contracts, but they've come under some scrutiny recently because of their interest rates. You have crypto, which is very volatile if you don't know what you're doing, and there's lots of other ways you can invest your money. Now, one very attainable to us these days is to invest in the likes of stocks and shares, because you can get started very, very easy, generally with any amount of money. And they can be quite fun too, and they've made it relatively foolproof for the likes of me and maybe you also. One very attainable way of investing money these days is to use stocks and shares, because they are very easy to get started with a pretty low amount of money, and they're quite fun too. They've made it very foolproof for the likes of myself when I'm investing in various stocks and shares. That is, provided you follow some core principles that we are going to go through in this video. Okay, I mentioned them already. What are shares? Okay, shares are effectively buying a piece of ownership of a company that you have invested money in. So this can only happen with what are called public companies, i.e. companies where you can invest money in them because they are publicly available to invest in. Now, not all companies are public. They be what's called private. To give you an example, I'm in the startup game in my day-to-day businesses, and I'm always telling my girlfriend about different businesses that are doing really well and I expect will do very well in the future. And she has often said to me, why don't you just buy stocks and shares in them? Now, the thing is, it's not possible to buy stocks and shares in those companies unless they what's called IPO, which is an initial public offering. And if a company gets to that stage, what they're doing effectively is they're putting their stocks on the public market where everyday people like you and me can invest. Otherwise, you'd have through that company, which is a much bigger process and involves contracts, and we're not going to talk about any of that in this video. So the idea is that when you put, say, X amount into Tesla, you would like Tesla to perform really well because the company's net worth will increase along with your investment in that company. So how do you make money from shares? Well, two things: the share price and dividends. Now, the share price is very simple. If you buy a share for $1 and it goes to $1.20, you've made a 20% gain on your investment. Now, you can also make money off what are called dividends given through the shares. Dividends are payments that a company makes to share its profits with its stockholders or its shareholders. So if Tesla made a really, really great profit, they may decide to distribute that profit among their shareholders to keep them happy and to thank them for investing in their company. Let's do an example. Let's say you have $100 dues, right? And you decide to spend that on Tesla stocks because Elon Musk is going on Saturday Night Live or something on those lines. At the time I invest in these stocks, they cost $1,000. That means you have bought 1/10 of a share. Okay, so 10 divided by 100 is 10%, so you bought 1/10 of a share. And let's say Tesla has issued 100,000 shares. Okay, so that means that you officially own 1/10 of 100,000, so you own 0.00001% of Tesla. Congratulations, that is officially yours. So let's fast forward a year now and pretend that the stock is now worth $2,000 and you're delighted. And you heard that Tesla is using 1 billion of their profits as dividends because the year was great and everything is fantastic and everybody's happy. So now you need to see how your share has performed. So if you look at the share price, right, you invested when the share was $1,000, it's now $2,000. So you have doubled your money. So your initial investment of 100 will go to 200. Happy days, that's great. Now you also need to look at the dividend side of things. So you own 0.0001% or whatever it is of Tesla. So you will get that percentage multiplied by whatever they're giving out to their shareholders as dividends. So that multiplied by 1 billion should get you an extra $100. So now your initial investment that was worth $100 is now worth $300. Why? Because you've doubled your initial investment from the share price and you've also gotten an extra $100 from the dividends that Tesla has given out. Now this is a highly unrealistic example because the amounts are made up and you're not going to get that much in dividends every year. But there are instances where dividends can give you an income as well if you have enough invested in a stock. Nevertheless, I hope that really unrealistic example gave you enough context to understand a little bit as to how you can make money from shares. So next up we have, how can I buy a share? Now this is where people tend to get a bit confused and where they think it gets complicated. As we said, you can't go to Tesla and buy a Tesla share. You need to do it through what's called an online broker. Every country has different brokers, right? And they need to jump through loads of different hoops to become a broker. Buying it now is a lot easier than buying stocks and shares than it was before. These days you have genuinely thousands of brokers offering their services. Now I'm based in Ireland, so there's a few like Darragh, eToro. I know the big ones in the UK as well are like Vanguard and Charles Stanley Direct. And what you can do is you can use these guys to buy your stocks through. As we said, this is where people falter the most, so please don't turn off yet. This is actually the easiest step. All you need to do is go online and have a look. Okay, so we're on Google now. Let's have a look at a few different carriers that we can use. So let's look up Vanguard, number one. Can't spell, sorry, the pressure of the camera is getting to me. So here we are, Vanguard Assessment Management. So the difference between all of these exchanges is their fees. That's the only thing, right? So you want to go with a crowd that give you good fee structures and that don't charge you a lot of money. So you can have a look at yourselves, see what the fees are. Realistically, any of the big guys are going to be good because they're going to really protect your money and manage it. Here you can look at fees, say for Vanguard, and you see that they have an ongoing cost of 20%, or sorry, of 0.2%. I presume that's of your money, and then they have a low one too. You might compare that with someone else like eToro, who seem to be quite popular. Now I know eToro's fee structure is a little bit different to the traditional brokers. They obviously offer loads of stuff where you can look at stock, ETFs, cryptocurrencies, etc. Their fees are a little bit different, and I'll show you why. Because they take 0% commission on anything you make, but they make money a different way. So they make money through different types of fees, conversions, and I presume when you take out money and when you withdraw money, that's when they really start to make their money. So the idea behind it is have a look at them, decide which one you want to use. Personally, myself, I use Darragh. Now I use Darragh.ie. There's also Darragh.com and .co.uk. They have low trading fees. It's very easy platform to use, and you can simply open your account with your passport, a proof of ID, and from there you can do the rest of it yourself. It's really, really simple and really, really easy. So please don't falter at this step. All you need to do, put away 100 quid and then put this money in and then watch it rise magically, and then you can put more money in and watch over the years as it invests. Now, this probably brings us to another point, and it's how do you decide what shares to buy? The rule of thumb when you're starting out, and myself included, you don't want to buy individual stocks if you don't really know what you're doing. The reason is because it's a little bit too risky. You're exposing yourself to one specific company or one specific stock in the event that it might falter or might fall or something might happen, and you might lose all your money because you've effectively put all of your eggs in one basket. Just because Tesla has risen risen a lot in the past couple of years doesn't mean it will keep rising in the future itself, right? The past is no indication of the future. Apple seems pretty good right now, but tomorrow if Tim Cook announced that the iPhone had a bug or it had some crash that caused the phones to explode, you are completely and utterly overexposed. This is fine for day traders who are constantly looking at the market, but for the likes of you and me who want to just leave their money in there over a long period of time, you're best off going for an array of different stocks to make sure you're not spreading yourself too thin. And the best way to do that is through what's called an index fund. So you've probably heard the saying before, don't put all of your eggs into one basket. So think about it as your money being the egg and the company being the basket. If you drop the basket, you're screwed, right? You've lost all of your eggs. But instead, if you have what's called an index fund, you can put your eggs into loads of different baskets. So you might carry one at a time, but if you fall, at least you have the other 20 baskets behind you with all those eggs in it as well. So there's the index bit and there's the fund bit. The fund bit is where investors pool all of their money together, and then there's this fund manager that manages that money and decides what to invest in. So to give you an example, I don't know, have you seen The Big Short, but Michael Berry, the guy that plays the drums and he bets against the market, he is a fund manager. So someone that's managing a lot of money on behalf of a lot of people. Now where they're incentivized is that they get a percentage of the money that they make for the other people. The index side of things is what's called a stock market index. So one that you probably have heard of is the S&P 500. This is basically the top 500 in the United States. Now let me actually get it up here. 500 companies, and we'll get an idea of kind of what those companies are. So unsurprisingly, the likes of Apple, Microsoft, Amazon, Alphabet, which is Google, are all in the top 500 companies in the US. Now, if you go down a bit, you'll see some more companies that you've never heard of, or some of them you have, like Starbucks, Goldman Sachs, and you see all of these companies are piled together and they're ordered in terms of how much money is in that company, i.e. what's the market cap of that company. Now, if you go down here, you're going all the way down, there's companies all over here, and you'll see that you have the top 500 companies. So Ralph Lauren is the 500th company. And what the S&P 500 is it's a combination of all of those 500 companies put into one stock. So if Ralph Lauren invests in a new kind of clothing brand that they're bringing out, their stock price might shoot up. It might only be a small percentage of what you've invested in, but at least if Ralph Lauren came out and, you know, they were doing really dodgy stuff in some poor country, their stock price might shoot down. At least you're not overexposed in that. The best thing about it is that you're involved in multiple different companies at the one time. For example, Pfizer, I have no doubt is in here somewhere, their stock price might have shot up when COVID hit. Similarly, I don't know, likes of Ryanair or American Airways, those stocks would have shot down, so they would have balanced each other out. So why do people invest in this? Well, the first thing is that it gives you a good overview of the whole economy and the market, and the best part is that over time the economy will generally go up. Okay, so let's look at this. Let's go on to trading view. So this is the S&P 500, let's say over the last 30 years, okay? So you can see here by this line that it has gradually increased the whole way up over the last 30 years and has been doing this since the 1920s. So if you look at these points here where the market has crashed, you know, substantially over this period of time, this is basically where recessions happen or when the economy tanks. Now, the only way you can really lose money during these times is if you sell in the times of fear. So if you buy the stock up here and you sell it down there, you're going to lose money, no doubt about it. But if you buy it up here, even though the money has tanked, if you wait for another 10 years before selling it, your money value will be up here. So over a long period of time, you would have gained. Now, with regard to the S&P 500 and these things, these are done through algorithms. So whatever the top 500 companies are, you will be invested in it proportionally. So if you have $500, $1 will go into Apple, $1 will go into Alphabet, $1 will go into Ralph Lauren, etc. Now, what you're doing with this kind of thing is you're actually, you know, putting your money into betting that the economy will perform well. Look, even if you look at the economic crashes, for example, the one here that happened in 2007, 2008, you see you would have lost a lot of money if you had sold during those peak times of fear. Now, if you hadn't sold in those peak times of fear and you waited a little bit more time, you see that your value would have gone up and up and up. And I don't know, can we go further to 1982 here? We can. Like, over the past 50 years, even when you take out this massive boom that we had in the dot-com bubble here, you can see that the value of your money would have increased over 30, 40 years. And that's why these things are arguably the safest way to bet when you're betting in the market. And the thing is, historically, very few funds have actually outperformed this index. I was watching a video from Ali Abdallah recently, and he was talking about how Warren Buffett bet loads of different index funds that they couldn't outperform the S&P over a long period of time, and he bet a lot of money. I'm sure he won because only one or two of them, over thousands of them, actually did do that. So you're doing pretty well investing in these because it's a pretty safe bet. Now, I can't tell you what to invest in, like this isn't financial advice, but my first investment was the S&P 500 because it's something that I'm going to leave in for a long period of time and let it grow over many, many years. Okay, so next part, could you lose your investments, or could you lose all of your money with investing? So you probably heard a story about someone that has lost a lot of money, or you've heard of people saying that it's really dangerous because they have lost money in the past. It's really important that we establish this. The only way you can lose money with investing is if you sell your asset for less than what you bought it for. Okay, let's look at an example on the laptop just so we can establish the rules here and that you fully understand. Let's say if I buy a share at this point here, right, the 1st of February 2016. The only way that I can lose money on buying that stock is if I sell it at a point where the value is less than what's on the right side, $1,907. Okay, now the good thing is there actually hasn't been a point yet where the stock has dropped below that. So I can't actually lose my money on that as of yet. But if I invested up here, let's say on the 18th of February, very close to what was a dark day for a lot of people in March 2020. So I bought the stock at 3,364. Now, if I had a short-term goal and I wanted to sell it quite quickly, I would realize my losses if I had sold it about a month later when the stock was at around $2,300. Now, if I had a long-term perspective, I actually wouldn't lose my money, and I'd say, okay, fair enough, there's going to be some rocky points in this long time period, but overall, and let's zoom out a second. Oh no, let's zoom out. Thanks TradingView for ruining the flow of my video. You'll see that the whole stock price will gradually increase over time. Now, ideally, like, you shouldn't be taking out any of these funds over the next 5 to 10 years. You need to think long term about this because you will be minimizing your risk by not realizing these short-term losses. You can see them here on the chart. There was a crash here, there was a crash there, there was another crash there. So the idea is that, with the dot-com bubble that happened around here, you're not going to lose your money if you have your money invested for a long period of time. Can it crash to zero? Yes, technically it can, but if it crashes to zero, you're going to have much more serious problems than the money that you've invested in this, because you're talking about the top 500 companies in the world completely collapsing. If that's the case, we're going to have much more serious problems than that. That's almost unfathomable. Now, fair enough, you could probably say, what if I invested in Bebo back in the day, if you still remember Bebo? Fair enough, you would have lost all your money on that, but the idea is that index funds spread your losses. So even though you might have lost money on Bebo, if that was in the top 500 companies, at least you would have gained your money elsewhere and you'd be protected with that. Economies like this in these bad times survive these events, right? They'll always rock, but in the long term, they will always prosper in the long run. Okay, so when should I start and for how long? So let's do an example here on the laptop, right? So let's say you were 18 years old, right? And you want to put €1,000 every single year into an index fund, okay? So you're putting in €1,000 and you aim to take it out when you're, say, 50, okay? So that's 32 years that you're doing that for. Your interest rate, I think average is like 4%, but we're just going to throw in 5% just to be a bit optimistic and to prove a point. It is compounded yearly, and as we said, every year you're putting in €1,000. Okay, let's calculate this to see what you'd end up with after those 32 years. So you have now €80,000 by the time you are 50. So the total interest that you've earned is €47,000 because you put it into an index fund as opposed to a bank account. You should have had €32,000 if you were to put it in your mattress, but you have actually over doubled your money because of this interest. Now, imagine if the interest was higher and you were really, really good investing and you were getting like 10% interest every year. You'll see the difference that that few percent makes in the initial investment. So instead of having €80,000 by the end of it, we will have €222,000. So the idea behind it is that the more money you put in for the longer time period you have it in, the more money you are going to make in the long run. So the longer you're in the market, the better, right? The Motley Fool have a really good daily newsletter, and they have really good tips for everyday investors like you and me. And they have a few things to consider before putting money into investments. The first thing is that to make sure all your debts are paid off. You don't want debts when you're investing, because you don't want that to outrun the interest rate and you're losing more money in the long run. Second thing is that you should also have an emergency fund as well of 3 to 6 months of living expenses in case you go through a time of extreme financial difficulty. Now the problem is that if your emergency fund is in index funds, when you are realistically going to need that money is when a recession hits. And when a recession hits, the stock markets are doing pretty poorly. So you'll have to realize your investments, or realize your losses even, when you take out that money. So it's best off to have your emergency fund actually in cash, right? Because that protects it in case the stock market does crash in a time in which you need it. Finally, the third thing, don't put your money into stocks that you think you're going to need in the next 3 to 5 years, okay? If we look back to the S&P 500 here again, if you have it in for longer than 5 years, you'll be able to navigate through these times of difficulty and actually not realize your short-term losses. There's almost no way your future self is going to regret putting money into an index fund or an S&P. You should do it now, provided that you meet all of the conditions that we were talking about above. And if you're like me, there was a long time where I was saying I'm just going to wait for the market to crash and then I'm going to buy in. But that crash hasn't happened, and since I said that, the market's after going up so much since. So I just bought in anyway because I saw a quote. I actually don't know who it's from, but it's so true. It's not timing the market, it's time in the market. So if a crash did happen after I invested, I just put more money in at that time. I'd be dollar cost averaging at that rate. How much do I need to get started? You can start with whatever you want, okay? Whatever you're comfortable with. Different websites have different requirements for the kind of minimum amount that you can invest, whether it be 10, 100 or 1,000. But the money that you're putting in, you need to make sure you're not going to need for a while, okay? That's how you can decide. I wish I did it earlier. Like I said, when I was 16, spending money on silly things like food and water. And I should have been starting my good financial habits of investing what extra money I had, because I knew it would be good to have in the future. I should have started watching videos like this. So what I'd say to you, whether you're 16 or whether you're 86, well, if you're 86, best to spend the money, but use this opportunity to go on to Vanguard, eToro, DeGiro, any one of those sites, register and put some money in, okay? That's the hardest thing to do. It may seem like a difficult first step, but trust me, once you have that done and you see it rise through the magic of compound interest, you will thank yourself in the future. Okay, finally, last thing to do, right? Find an online broker, okay? Whatever country you're in, Google online broker, Ireland, Nigeria, UK, and pick one with a good interest rate just to get started, right? You can always change down the line if you need to. Index funds are a great way to secure your bet over a long period of time, and they also have pretty low fees associated with them. Set it and forget it. Okay, the money will magically grow over time, and look, hopefully when you need it in the far future, that money will be a lot more than what you initially invested, provided you followed some of the rules that we talked about in this video. I do sincerely hope that this was some reasonable introduction on how to get started on stocks and index funds and investing. If you have any questions, because there probably will be a few questions, do put it into the comments below. Now, if you are interested in investing in general and you not only want to invest in stocks but also are thinking about putting a small bit of your portfolio into something maybe a little bit more risky like cryptocurrencies, you might want to check out my cryptocurrency series for beginners up here, where I run through from start to end on how cryptocurrency investing works, how you can avoid the pitfalls, and how you can make pretty substantial gains by following a core set of principles. Other than that, we will see you in the next one. Thanks for watching till the end. Slán.